Ever dreamt of joining the world of real estate investors, but felt priced out of the hefty down payments and closing costs? Don't worry, that dream property might be more within reach than you think. In this video, we will explore creative strategies for getting your foot in the real estate market, even if you're starting with limited funds. One of the easiest ways to invest in real estate without needing a lot of money is through REITs, also known as real estate investment trusts. A real estate investment trust is a company that deals with real estate that generates income. Think of it like a mutual fund, but instead of investing in stocks or bonds, a REIT invests in real estate properties. These properties bring in money mainly through rent or leasing, and that income is then distributed to the investors as dividends. It provides a convenient and accessible way for anyone to start investing in real estate, even with a small amount of money. In 1960, Congress created real estate investment trusts by adding an amendment to the cigar excise tax extension. This move was significant because it opened up a new way for people to invest in real estate. Before REITs were established, investing in commercial real estate was mostly limited to wealthy individuals and large financial institutions. Ordinary investors didn't have the same opportunities to buy into big real estate projects. With the creation of REITs, this changed. It allowed people to buy shares in a portfolio of real estate properties. This means that regular investors can now own a piece of a large commercial property without needing a lot of money. Here's how it works. A REIT collects money from many investors and uses it to buy and manage real estate properties. Investors then earn a portion of the income generated from renting out these properties or from selling them at a profit. Because REITs pool resources from many investors, they can afford to purchase and manage large, expensive properties that individual investors wouldn't be able to buy on their own. The types of properties that REITs invest in are quite varied. They can include apartment complexes where people live, data centers that store large amounts of digital information, healthcare facilities like hospitals and clinics, and hotels where people stay when they travel. Additionally, REITs might invest in infrastructure such as fiber cables, which are crucial for internet connections, cell towers for mobile phone networks, and energy pipelines that transport oil and gas. Office buildings where businesses operate, retail centers where people shop, self-storage units where individuals and companies store their belongings, timberland used for forestry, and warehouses where goods are stored and distributed are also common investments for REITs. Most REITs focus on one specific type of real estate. For example, a REIT might specialize only in office buildings or only in apartment complexes. This specialization allows them to become experts in managing and maximizing the value of those particular types of properties. However, there are also diversified and specialty REITs. Diversified REITs hold a mix of different types of properties in their portfolios, providing a broader range of real estate investments. Specialty REITs may focus on niche areas like infrastructure or timberland, but still include various property types within that niche. This structure allows investors to invest in specific real estate sectors or a diversified portfolio of properties depending on their preferences and investment strategies. There are three main types of REITs. Number one, equity REITs. Most real estate investment trusts are what we call equity REITs. These companies own and manage properties that bring money through renting them out. They don't usually make their money by buying and then selling properties. Instead, they focus on generating a steady income from rent. Some well-known examples of equity REITs include Ventas, which focuses on healthcare properties like hospitals and senior living facilities. Another example is Simon Property Group, which owns and operates shopping malls and outlet centers. Essex Property Trust specializes in residential properties, mainly apartments, while Alexandria Real Estate Equities focuses on office buildings for life sciences companies, such as those involved in biotechnology. Number two, mortgage REITs. Mortgage REITs provide money to real estate owners and operators through mortgages, loans, and investments in mortgage-backed securities. They earn money from the interest on these loans or securities. The primary way mortgage REITs make money is through the net interest margin, which is the difference between the interest they earn and the cost of borrowing money. For example, if a mortgage REIT lends at 5% interest and borrows at 2%, their net interest margin is 3%, determining their profit. Mortgage REITs are sensitive to interest rate changes. If rates rise, borrowing costs may increase faster than the interest rates they earn, shrinking their net interest margin and reducing profits. Conversely, if rates fall, profits can increase as borrowing costs decrease. Investors can explore options like Arbor Realty Trust and AGNC Investment Corp. Arbor Realty focuses on real estate lending and mortgage-backed securities, while AGNC invests heavily in mortgage-backed securities for income. Number 3, hybrid REITs. Hybrid REITs combine the investment strategies of both equity REITs and mortgage REITs to create a diversified approach to investing in real estate. If you're enjoying this video, hit that like button, subscribe, and turn on notifications for more valuable content. Investing in real estate investment trusts can be a great choice for many reasons. One major advantage is that you don't need a lot of money to get started. Unlike buying physical real estate, where you need a significant amount of cash for a down payment and other costs, with REITs, you only need enough money to buy a share. For example, if you want to invest in Simon Property Group, a well-known REIT, you would need approximately $146 per share as of the 21st of June 2024. This is much more affordable than purchasing a property, which can cost thousands of dollars. There are also many other REITs available that cost even less per share, making it easy for almost anyone to start investing in real estate. REITs provide investors with a way to diversify their portfolios beyond just stocks and bonds. When you invest in a REIT, you're essentially buying a piece of a large pool of real estate investments. These can include different types of properties. One of the key benefits of REITs is that they help spread out risk. In other words, your investment is not tied to the success or failure of a single property or type of property. Because REITs invest in a variety of real estate sectors, if one area isn't doing well, the other areas might still perform well. For example, if the housing market is struggling, commercial properties like office buildings or shopping centers might still be profitable, helping to balance out potential losses. Real estate investment trusts also give investors a way to invest in real estate without the need to buy and manage actual properties themselves. This can be a huge advantage because managing a property takes a lot of time and effort. Property owners have to deal with maintenance, tenants, and other responsibilities. This can be particularly challenging for people who have full-time jobs or other commitments. REITs take away these burdens because properties are managed by professionals. Additionally, investing in real estate directly requires a lot of knowledge and expertise. Investors need to understand the market, know how to find good deals, and be aware of legal and financial aspects. For those who lack this expertise, investing directly in real estate can be risky. REITs are managed by experienced professionals who make investment decisions and handle the complexities of property management. Real estate investment trusts are investments that are very easy to buy and sell quickly, almost as easily as clicking a button. This is called high liquidity, and it's important because it means investors can get their money back fast if they suddenly need it. Imagine you put $100,000 into a down payment for a house. If you needed that money right away, it would take time to sell the house and get your cash back. But with REITs, it's different. If you invest in REITs and suddenly need your money, you can quickly sell the shares of the REIT you own. This means you can turn your investment into cash without waiting. Income from REITs is often seen as very dependable. This is because REITs usually own commercial properties like shopping malls or office buildings, and these properties are leased out to tenants. For example, think about a big shopping mall owned by a REIT such as Simon Property Group. Each retail space in the mall is rented out to different stores, and these stores typically sign leases that last for several years. This means the REIT receives regular income from rent payments, which adds stability to their earnings. Because these leases are long-term, they provide a predictable source of income for the REIT. Even if one tenant leaves, there's usually another one ready to move in, ensuring that the property continues to generate income. This income stability is one of the key reasons why investors often find REITs attractive. They provide steady dividends and are relatively resilient investments in the real estate sector. Real estate investment trusts are required by law to distribute at least 90% of their taxable income to their shareholders in the form of dividends. This makes REITs particularly attractive for investors who are looking for regular income from their investments. For example, companies like Simon Property Group, which is a well-known REIT, offer a dividend yield of around 5.47%. This means that if you invest $1,000 in Simon Property Group, you could expect to receive about $43 in dividends each year. One of the reasons REITs tend to pay high dividend yields is that they're structured in a way that allows them to avoid paying corporate taxes. Instead of paying taxes at the corporate level, REITs pass the majority of their income directly to shareholders. This tax advantage enables REITs to distribute a larger portion of their profits as dividends compared to regular corporations. Investing in REITs can be attractive, not only for the income they generate, but also for their potential to provide higher returns over the long term. On average, equity REITs which own and operate income-producing real estate properties tend to pay higher dividend yields compared to the average dividend yield of stocks in the broader market, such as the S&P 500. While the average dividend yield for stocks on the S&P 500 is around 1.9%, equity REITs typically offer dividend yields of about 5% or more. For a complete list of REITs, you can go to reit.com. They have a detailed directory of all publicly traded REITs. The website is also a great place to learn about investing in REITs. Now, let's shift our focus to the disadvantages of REITs. One major risk of investing in real estate investment trusts is how their dividends are taxed. The income you receive from REIT dividends is typically taxed at your regular income tax rates, which can be higher than the rates for qualified dividends. However, there are exceptions to this. If you hold your REIT investments in a Roth IRA or a 401k account, you either won't be taxed on these dividends at all, or you will benefit from tax advantages. For example, in a Roth IRA, all dividends and gains are completely tax-free, which can make REITs a more attractive investment in such accounts. Another risk of owning REITs is that their potential for appreciation might be limited. The reason for this is that REITs are required to pay out a large portion of their income to shareholders in the form of dividends. Because they distribute so much of their earnings, they have less money left over to reinvest in growth opportunities. This can lead to slower growth in the value of the REIT itself compared to companies that reinvest more of their profits back into the business. Another disadvantage of investing in REITs is the market risk. REITs are more vulnerable to economic downturns and other financial challenges than some other investments. So when the economy is struggling, the value of REITs can drop significantly. For example, if we look at Simon Property Group, which is one of the largest REITs, its stock price has experienced major declines during tough economic times. In 2008, during the housing recession, Simon Property Group's stock price took a huge dip. Then in March 2020, when the COVID-19 pandemic started, the stock price fell sharply again. These examples show how sensitive REITs can be to economic problems. In addition to market risk, some REITs come with high management and transaction fees. A big portion of the money invested in REITs goes towards paying the people who manage the properties and handle transactions. These fees can eat into the returns that investors get, making REITs less profitable compared to other investment options. If you're considering investing in real estate investment trusts, it's important to start by looking for REITs that have been established for a long time and have a history of consistently growing their funds from operations. This shows that the REIT has been able to generate steady income over the years, which is a good sign of stability and reliability. You also want to check their track records to see how well they have performed over time. When evaluating REITs, many of the principles you use to assess a good stock can be applied. For instance, you should look at specific metrics to understand their profitability and overall health. One important metric is funds from operation, which gives you an idea of the cash generated by the REIT's properties. Another key metric is net operating income, which shows the income from the properties after operating expenses are deducted. Occupancy levels are also crucial because high occupancy rates mean that more of the REIT's properties are rented out, leading to more income. Additionally, rent per square foot can tell you how much revenue the REIT is making from its rental spaces. For example, if you visit Simon Property Group's press release website, you can find detailed information on these metrics. Reviewing this data can help you make an informed decision about whether a particular REIT is a good investment. If you want to save time and still make smart investments in real estate, you can consider investing in a REIT ETF. An ETF, or exchange-traded fund, invests in a lot of different stocks at once. So instead of choosing just one REIT, you can invest in a REIT ETF that spreads your money across many different REITs. This helps increase your diversification, meaning that your investment is spread out to multiple companies and not tied to the success of just one company. One example of a REIT ETF is the ticker symbol VNQ, which is offered by Vanguard. VNQ owns shares in 174 different publicly traded REITs and other real estate-related investments. When you buy shares of VNQ, you're essentially getting a piece of all these different REITs. This diversification helps reduce your risk because your investment isn't dependent on the performance of a single REIT. If one REIT doesn't do well, the others in the ETF can help balance things out. Moreover, holding a REIT for a long time can be very beneficial. REITs typically pay dividends, which are regular payouts to shareholders. When you reinvest these dividends, you're buying more shares of the REIT. Over time, this process of reinvesting and earning dividends can compound, meaning your investment grows faster because you're earning returns on both your original investment and the reinvested dividends. This compounding effect can significantly boost the value of your investment over the long run. Many REITs are publicly traded and their shares are available for purchase by the general public. These shares are listed on national securities exchanges, similar to company stocks. This setup allows individual investors to buy and sell REIT shares throughout the trading day, just like they would with stocks. With this strategy, you can build your real estate portfolio with minimal upfront capital. Which of these REITs would you be investing in? Let us know in the comments section below. If you found this video helpful, please like and subscribe for more valuable content and financial insights. Thanks for watching.